Hello there, and welcome to another instalment of the Networth Network. My name is Toby Street. I'm sat here again with Jeremy Harbour. Today we're going to be talking about a topic that I think gets probably bastardised slightly and bounced around a bit without people really understanding what it means and the depth of what it means. And that is a balanced portfolio. And that doesn't necessarily just mean asset classes, it means lots of things within asset classes as well, which we will go into some more depth about right now. What's the kind of definition then of a balanced portfolio for somebody who has one?
Yeah, I mean, so the most important is diversification. So that, and when you think about diversification, think about diversification of financial products. So if we just focus on the kind of in the market stuff, so you've got bonds, you've got stocks, and then you've got alternatives. And alternatives are things like REITs and MLPs. So a REIT is a real estate investment trust. So it's a company that's listed on the stock market that owns real estate interests. In fact, it's a great way of investing in property without having to deal with tenants and broken boilers, is to buy a REIT and you get a nice percentage yield on that. You then have a whole load of things like funds and ETFs. I'd probably swerve away from too much exposure to mutual funds. Some of the ETFs are quite a good way of getting cover across certain things. But again, what they tend to do is generalize across a whole sector, whereas in every sector there are good companies and bad companies. So I would tend to go heavier on stocks and bonds than stock and bond ETFs, which tend to be a bit more general. But basically the key would be within those in the market products would be to make sure that you have stuff in bonds, and then in the bonds you should look at lots of different countries. So don't just have US bonds, don't have just Japanese bonds, but try and hedge yourself across lots of different countries. Within the stocks, it's also a good idea to hedge yourself across lots of currencies. So having Singapore dollar investments, Hong Kong dollar investments, Australian dollar investments, US dollar investments, and euro investments, and so on and so forth. Currencies are all in pairs, so if you're hedged across all the currencies, it doesn't matter if one goes down because one only goes down relative to the others, which means the others have gone up. Hedging currencies is a good idea within a balanced portfolio. You should never have really more than 5% of your money tied up in any one company or area of exposure.
And that includes, obviously, if you're running a business right now, that same one.
Yeah, absolutely.
Ideally.
So if all your wealth is in your own business, then you need to sell it.
Highly exposed, potentially.
You have all your eggs in one basket. And then outside of your the market-based stuff, and the market-based stuff is probably the place to start because it's the easiest place to build up a nice income-generating, very passive asset class. Outside of that, you should own some property. It's good to have high-yielding, easily managed property. Tends to be small apartments, that kind of thing. It's probably a good idea to have things that have some capital appreciation aspect to them, but only once you've sorted out your income-generating stuff. So investment land and things like that can be a good opportunity. Cover in lots of different types of asset class. I mean, there's some more esoteric things you can do, like you can become an insurance underwriter through Lloyd's of London. Again, that's only open to people with more than sort of 7 million or so in net assets, but that's a good non-correlated investment, and it does provide quite healthy incomes historically. They've taken away the unlimited liability aspect of it, so it is now a much safer investment than it used to be. That would be my definition of a balanced portfolio across lots of countries, across lots of sectors. And don't go for the stock picks, don't go for the people giving tips and all that sort of stuff. Just buy big, boring companies that consistently yield high dividends. One thing to watch out for is withholding tax. So certain countries have withholding taxes on the income that you make on your investments. So, for example, you might look at some of the real estate investment trusts in the USA. I own a few. One that does very well for me is called ARCP, which gives about a 10% return. There's another one called Two Harbors, which gives about a 10% return. Both very good companies, both very well run, both give a reasonable or a very high dividend. But because I earn that money in America, they charge a 30% withholding tax on that income. So basically, if I lost money on them, I get nothing. But if I make money on them, they keep 30% of it before they send it to me. So whilst it's okay to be part of a balanced portfolio, it's also good to look at stuff outside of that. So for example, there are real estate investment trusts in Singapore, which own a lot of the shopping centres and the commercial office buildings and hospitals and things like that in Singapore. So there's businesses like Maple Tree Trust, Capital Mall Trust, Fraser's Trust. I've got most of these, and again, they're all around the kind of 6, 7, 8% yield, but no withholding tax. So actually, they do as well as a double-digit yielding stock would in the US. Yeah, keep an eye on withholding taxes. Hong Kong, the UK, and Singapore have no withholding taxes, so they immediately become quite attractive. So things like GlaxoSmithKline, HSBC, Centrica, massive companies, they're yielding in excess of 5% as we record this video, 5% per annum. So if you think about it, that's the equivalent of kind of 8% in the USA. So you get UK companies, and they're very large companies. They're very well capitalised. They have big stock volumes. So and again, people say, what if HSBC crashes because it's loses its tax investigation or something? I'd probably just buy more of it, because that means it would go from a 5% yield to a 6 or 7 or 8% yield. So don't worry about stock prices. Worry about the income that you can buy.
It's probably also quite important to state at this point that this whole strategy is kind of in place to protect you from yourself. If you're an entrepreneur, then the chances are, when you have a massive capital event in your life, you want to go and plough it into a load of startups, or you want to go and plough it into a load of opportunities that have come to you.
Boats and cars and divorces.
Well, exactly, yeah. That really is a very dangerous way to go about things, unless you love living life on the edge. But most people do want to build in some security. If you've got kids and a family, then you're going to want to make sure that they're okay in 5-10 years' time, and that you're okay along the way.
Creating a core portfolio that will just give you an income that doesn't go away.
Yeah. By all means, keep some back. 5% of your wealth. If you want to have a pot to play with in terms of helping some startups and things, then fantastic. But again, seek help with that too. There's plenty of people out there and funds out there that you can invest in that might be able to offer you a higher return every year, but there'll be higher risk naturally. It really is about balance. Yeah. Great stuff.
Thank you.
Once again, if you enjoyed this video and you're enjoying the videos that you've seen on this website or on YouTube or wherever you found it, then by all means enter your details below. We're going to pump out a video roughly once every week, and all kinds of different topics, everything to do with wealth creation, protection, and growth. We get some fantastic feedback. Loads of people are always emailing us every single day, pretty much. Giving us all kinds of feedback, some not so positive, some very, very positive. Depends where you're coming from, really, and what point you are. But we definitely think that these videos can help wherever you are on the kind of wealth scale. There are some hints and tips that can really benefit you. Look forward to seeing you soon.